We can go and borrow money from the banks that will go less because people will give them money at 0% interest. We see that all day long and saw it for 20 years with people in checking accounts. So then we can use the benefits of their stupidity to get us access to cash cheaper while ours is earning more, and we can go do more.
This podcast is for informational purposes only and does not constitute financial, legal, or investment advice. Please consult a professional advisor before making decisions based on what you hear on this show.
So here's what's happening right now. The Federal Reserve has signaled that they're going to potentially cut rates the next two meetings. And what does that mean for us? Does that mean borrowing costs are going to go down? Does that mean the economy is softening? As entrepreneurs, as investors, infinite banking owners, what does that really mean and how can we take advantage of it? So today we're going to talk about all of these things, how asset values may be shifting, borrowing costs may be changing, and liquidity comes into the system. And what will that mean for us as we head into 2026? I'm Russ Morgan. I'm one of your hosts today. Thankfully, I'm not here by myself. I'm surrounded by the dream team of financial coaches. To my right, I got the Italian stallion, Mr. Joey Murray. Stallion, good afternoon.
What's up, my brother?
Well, Joey, if they're really going to cut rates, I'm sitting over here thinking that that's what's going to happen. Why should entrepreneurs or infinite banking clients care about this, especially maybe even if they're not borrowing money from banks in the traditional way?
Well, here's the thing. If you understand economics, you have to understand there's a boom bust cycle, which is tied directly to what we're talking about. When the Fed increases rates, lowers rates, it is causing some of these cycles to take place. So when the cost of capital drops, people are more likely to take on more risk. They don't see it as risky. And so they go into things that maybe they shouldn't have. They borrow more, they expand faster, which can push up valuations. So I think it's important for us to dive into this and dissect it a little bit, depending on which side of the coin you are, an investor, a business owner, or somebody who has infinite banking. How is this going to be affecting you in terms of short-term opportunities?
How many summers do you have left with your kids? 10, maybe less?
And are you spending them together, or are you still stuck in the office while time slips by?
You want freedom. That's not the problem. The problem is you don't have a system that buys back your time. Without it, 3 years from now, your kids will be older and they won't care that your business was more successful. They'll remember you weren't there.
That's why we built the passive income operating system, the plan we use to create over $50,000 a month in passive income. The system isn't free, but the training that shows you how it works is, and it's under an hour.
Go to wealthwithoutwallstreet.com/PIOS. Take the first step to buying back your time now. Wyatt is back for the second time. Good to have you back, Wyatt Payne.
Great to be here.
You obviously spend a lot of time in our passive income lab. You're helping our students evaluate their investor buy box, helping them do due diligence. You yourself are a fantastic investor. So when rates go down, how does that impact investments out there?
So when rates go down, it tends to flood the market with more opportunities. When rates are high and money is tight, that kind of weeds out some operators and syndicators in the market. So when rates come down, things get a little more flexible, and you tend to see more deals out there on the street.
Well, sometimes that's a good thing, but sometimes that could create a little risk in the marketplace. True?
True. That is true. And there's risk and reward to evaluate.
Yeah. All right. I got the recovering CPA back, Mr. Anthony Faso. Good to have you back, Anthony.
Glad to be back.
What is your take on this? Obviously, lots of different angles from both passive income, but also from infinite banking. What do you think about rates coming down, and what should we be considering?
I would say when they came down, my first reaction, I was excited. To me, I think it was a positive sign on the economy. And also, I have a large amount of policy loans. And I don't know if we're going to get into it, but we're using the a life insurance line of credit strategy. So immediately my loan rates went down, and now I'm hearing it's going to go down two more times this year. But for the most part, here's one thing I think is important. We get so focused on these interest rates. One thing Nelson had talked about, it's not about the rates or that we're paying, it's about the volume that we were earning. A lot of times we get too in the minutia of the details. When it comes to infinite banking, in my eyes, I don't think interest rates, they are what they are. They're going to go up, they're going to go down. We can't control it. But what we can control is how we leverage our cash value. So I think with these lower interest rates, it's going to create some opportunities, particularly if we want to create that passive income.
Yeah, I mean, you think about it, people have maybe been sitting on the sideline. Maybe their money's been sitting in checking accounts, savings accounts. Maybe you're one of them. You're earning 4 or 5%. I love riding down the major freeway here in
Yeah.
Birmingham. You're seeing those signs, and I'm seeing them like, adjust those signs. They've been going down here for the last 12 months. They'll continue to go. So, what will end up happening is that as rates go down even further, people are going to say, hey, maybe it's not as beneficial for me to keep money sitting in these checking and savings accounts because now I truly know I'm probably not keeping up with inflation. This is going to trigger them to look for alternatives. Infinite banking is one of those because they want safety, they want long-term returns, they want to make sure that they're not, subject to the Fed's discretion and mercy, if you will. So I want to break this down a little bit further about what's really happening in the market, Stallion. So, what are some of the mechanics behind how rate cuts do ripple into borrowing costs, asset valuations, and the cost of capital?
Well, you think about it, when rates are cut, borrowing becomes cheaper, which pushes up asset values. It also creates a little bit of a frenzy. So you start having more demand in the market, which also pushes up asset values. I think what you saw leading up until the early 2020s, you saw all sorts of people just jumping into the commercial sectors, like getting into different multifamily deals, and because they're so cheap. And all of a sudden, what happened? You started to see these deals getting flipped, sometimes in 12 to 18 months to the next buyer because there was so much demand. Well, it didn't take long. Once those rates went up, it immediately just shut down everything. So, but in light of where we're at right now, you're going to start seeing commercial real estate valuations going up because net operating income drives the valuation. And what part goes into that is what's left over after my debt service. And so you have in all the other expenses, right? And so, man, we're going to start seeing those valuations rise. We're going to start seeing more and more people coming out of the woodworks trying to get money at work. And I think there's also a little bit of a concern about that because you don't want to be on the top end of that whenever things maybe shift. And we've already been through that many times. This is a boom bust cycle. I can't reiterate that enough, but we're definitely potentially on the good side of that.
Yeah, well, we can't. I mean, yeah, it's hard to say good or bad, right? I mean, it is. I think it's all bad. To your point, is that in the ideal world, we wouldn't have a central bank dictating this because it is creating booms and busts. So at one point, we feel like we're riding on the roller coaster. The next thing you know, we're the person upside down in a free fall, and that doesn't feel very good. Anthony, for those who want to understand just the basic mechanics of what's
Yeah.
happening to assets and asset values when they had something that was earning, could you maybe give an example that may make sense to the person, running on a treadmill right now?
Sure. Or try to explain it so even Joey can understand.
That'd
Okay.
be ideal.
So,
That'd be ideal.
sorry, I normally I don't have Cameron here. I got to pick on somebody, and I don't know Wyatt well enough yet to make fun of,
Okay.
but we're gonna get there. But Russ, let's say, for example, that you were looking for an investment, and that investment was paying you $10,000 of cash flow or income. Here's where the interest rates come into it. Because if you're expecting an 8% return, then you would be willing to invest 125 grand to get 10 grand back, which would be 8%. But let's say interest rates drop and investors are fine with 6%. That asset's still producing 10 grand, but an investor would be willing to pay 166 grand for that same asset. And 166 times 6 would be the 10 grand.
Yeah.
So the asset really didn't change, but what the investors were looking for did. And so the impact of the lower interest rates will actually, in reverse, increase the value of some assets.
Uh, Why we talk a lot about becoming your own banker, right? And I know you have students that leave from setting up their banking systems. They come over to the passive income lab where you act as one of those coaches, helping them understand what to do with that money. And part of understanding what to do with the money and is understanding how banks work. So for the person who maybe not as uh, educated on where rates impact banks, would you help them like just do banks like lower rates? Most people would think they like higher rates.
Yeah, they do like lower rates because a bank's always going to make money, whether the rates are high or the rates are low. They're the ones in control. They're going to find a way to make a spread between the cost of money that they are working with, and then the cost that they lend those dollars out to others. And it actually gets better when the rates go down on a percentage basis. So the banks are going to find themselves doing just fine.
Yeah, I mean, they make off the margin, right? The more money comes in, the better. So, Anthony, how does that impact insurance companies? We start talking about dividend scales and everything like that inside an insurance policy. Somebody may wonder, man, if the insurance rates or if the rates on bonds are going down, does that mean I'm going to see my insurance policies now significantly hit because of this?
Russ, that's a common misconception, right? But that's like the inverse of what we had just talked about on assets. If they have a bond portfolio, when interest rates go down, those bonds are actually some of them are going to be worth less. So what we need to do, but what is unique about what the life insurance company is doing, they're not trading bonds, they're investing and holding bonds. So when they buy a 10 or 20 or 30-year bond, they're holding it for the entire time. And then when that renews, then they're buying another bond. So what that allows them to do to weather the storm in the volatility of interest rates. So as far as the impact is really minimal, whether they go up or whether they go down in the short term, but it makes more of an impact on the long term. But I will say, in regards to loan rates, that's where we're going to see more of a direct impact. And I am hoping that we will start seeing some of the policy loan rates go down. But also, we also need to realize uh, the more the insurance company makes, the more money we're going to get into dividends. So, and again, they are a mutual company. So it's not like they're charging us more, so they're making more. The more money they make, the more money we make. So as far as the interest rates, when we're IBC, one of the many advantages of that, I don't think we're not as as we're not interest rate sensitive as, but also as I alluded to earlier, I'm instead of using my cash value as collateral and borrowing from the insurance company, I go to certain banks we work with, and I use that same cash value as collateral. The advantages of doing that, now I have bank privileges. I have, particularly if you have multiple policies or you use the money very quickly, this can be very advantageous. The downside, or it depends on where we're at, but these loan rates are directly tied to the prime rate. So whenever the Fed raises or lowers the rates, it's a direct impact on these loan rates. And what's been happening before, I tell you, a couple of years ago, these loan rates at these banks literally were 3%. Then when interest rates shot up, it was really not cost effective for most people to continue to use these lines of credit. I will say, I actually, during this time, did keep my lines open, and in part because the quickness to be able to manage and deploy that money was very advantageous to me. But now that these interest rates are going down, I'm seeing um, a direct decrease in my policy loans.
How much passive income do you have right now? And if in 5 years you're still at the same point, what's that going to cost you? Maybe more time at a job you hate or missing moments with your family?
See, most people don't move because they don't know what to do. So they just keep doing the exact same thing.
That's why we built the Passive Income Lab. It's a 12-week program where you are guaranteed your first $500 a month in passive income.
But here's the catch. It's not open to everyone. We only let in 10 people at a time.
So the real question is, will you be one of them? Apply now at choosepassiveincome.com.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
I want to touch on a couple of things that you said there for the person who's, a little bit distracted. What did all this mean for you?
Mm-hmm.
When life insurance agents, specifically in the infinite banking space, talk about lower interest rates that their insurance carrier is charging in a good way, run. Literally run. Like that is the first sign that they know nothing. They are the least educated. If they think a lower interest rate at their insurance company that they're charging you is a good thing, run. That's what you basically said, Anthony. Because when we understand how insurance companies work, the higher the interest rate, the higher the dividend, the higher the amount of cash value, the more cash value that we can use to buy more assets and create more passive income. So people who don't understand how insurance companies work and sell life insurance off lower interest rates, run. Now, there are ways to use lower interest rates to benefit us, right? And you just gave a high-level idea that when interest rates actually drop below what the insurance companies are willing to charge us, because they do have a floor, thank goodness. I don't want my values going down to zero. That's the reason why we choose whole life insurance.
Mm-hmm.
We can go and borrow money from the banks that will go less because people will give them money at 0% interest. We see that all day long and saw it for 20 years with people in checking accounts. So then we can use the benefits of their stupidity to get us access to cash cheaper while ours is earning more and we can go do more. I know that you said that in so many ways. I just want to be like pointing this out to people, like when they're trying to figure out when do I make decisions, because so oftentimes people make the Wall Street decisions. They want to leave Wall Street, but yet they want to keep using Wall Street. Like, oh, I want lower interest rates because that is benefiting me. So I want the insurance company with the lowest interest rate. Wrong. All right. Coming over to you, Stallion. We talked about that. So thinking about dividends and the scales of these, we go back to say 2020 when we saw rates significantly drop. Talk a little bit about that and what that what someone should consider in relationship to returns.
Well, I don't want to spend a ton of time on this because as Anthony alluded to earlier, we're in the banking business, and the interest pay versus the volume that we have at work is the real formula, right? But just to kind of nitty gritty this a little bit, in 2020, dividends were holding steady for 12 to 18 months, but the policy loan rates were dropping. And so that gave a very short-term spread advantage, meaning you could earn 5% while borrowing at 4%. Well, that's great. That's an advantage for a short period of time. But because if we just focused on that, whenever the tables turned and all of a sudden, policy loan rates increased, we would be thinking, oh no, I've made a big mistake or something like that. But the real power in this comes from when we utilize the loan function and we take that capital out to the marketplace, we get the advantages that the interest rate environment give us to invest. If this is your investing strategy, like if the policy is your investing strategy, you lose. I'm just telling you right now. If you're in IBC practitioners telling you that your policy is going to make you rich, they're lost. It's not going to make you rich. I promise you. It's the use of it. You have to become an investor who uses a tool like this to get to financial freedom. If you haven't already done this and you already have your system, you need to go to choosepassiveincome.com. You need to apply to see if you can get into our passive income lab, because you have to become an investor to get to financial freedom. And that 12-week course will guarantee you your first $500 in passive income. That's where everybody needs to go if they haven't already done so.
Good point. All right, so let's move to the investing side of this. Like, again, we're not here to give you investment advice. We are not investment advisors, but we do invest ourselves. We do think about investing. And so this is our kind of opinion on different things. Obviously, some of this is based upon our history of doing this personally and professionally for some of us. So why coming to you, which asset classes maybe benefit the most from the Fed easings, and maybe which ones are more riskier?
Okay. Yeah, great question. As money becomes cheaper, those capital intensive assets tend to start showing back up in the marketplace. The real estate, the energy, and the infrastructure, those things that require a lot of capital to come to fruition is where a lot of those dollars go. And that's great, but it can show itself as risky. If you look for example, in the multifamily boom of the probably 2013 all the way through to 2020, tons and tons of market building was going on. And at the tail end of it, as you got into 21, 22, the smart folks were hopping out of the market, and you saw others that had their gas pedal to the floor, and they kept doing things. They got riskier and riskier, bridge loans, floating rate loans, and then when the rates reversed and started going back up, that's where all the distress started creeping in. So those smart multifamily folks on the sidelines are going to start picking up those deals here in late 2025 and 26 going forward.
Yeah, you're totally right. I mean, it's a smart money knows when to get in and get out. Dumb money is the one that they're selling to, right? I mean, it's always on that flip side. So this is one of those opportunities where you see what's going to happen. People who haven't been able to move, whether that is selling an investment property they've been in, selling a primary home that they're in, they're going to be able to refinance out at cheaper rates. And that's going to bring more people to the table, right? That there's more money, there's more people chasing the deals. So what you have to look out for, especially if you're in some sort of rental world, is what are the rents rates doing in relationship? Are they going up? Are they keeping pace? And what I don't see is I don't see the economy increasing right now. I don't see people having more and more money. I think we're in this gap where they've said since 2020, the biggest wealth distribution has happened over the last 5 years, where the rich have gotten richer and the poor have gotten poorer. There is no middle class. Well, if that's the case, who's renting? It isn't the wealthy. So how are they going to be able to keep up the rent rates if their incomes are not keeping up with that? So I think that you're going to, see potentially that as an issue. So if you get in, you better be cautious as to how long you stay, because there may be an opportunity to get in and find a couple good deals. But if rates end up going right back up because they end up seeing, oh, the economy is starting to heat back up, and then the Fed turns around and changes rates again, that's where people get, left out with shorts down and the tide going out, if you will.
Hey,
Joey, what would you add to that? Or Anthony, you wanted to jump
well,
in?
one thing I wanted to comment on there, and like Joey had alluded to it, of some of these assets being increasing in volume or the appreciating. But in regards to real estate, now a lot of people might be more apt to move or to get in the real estate game. And in addition, with this big, beautiful bill that passed, it made buying real estate extremely attractive with some of the depreciation
Mm.
attributed to it. And which is valuable to me as a real estate investor, but I do get concerned more and more people are going to get into the game and that's going to be more competition. And that could artificially inflate these prices because people are chasing the depreciation tax deductions.
That's true, Joey.
Yeah, no, I think you guys hit the nail on the head. And, you know, there's two sides to the coin, and you have to be looking at it from both angles. Dumb money runs in just looking at one side.
Guys, so how should investors adjust maybe due diligence as maybe these cheap money return back in there? Joey, I'll let you jump in there.
Well, I'll just say you can't assume that rates will stay low forever. And so you have to model every deal that you're looking at based on higher future debt costs. So factor that in, especially if you have a floating rate. We learned this the hard way. A lot of people in the multifamily space, when they had bridge debt that wasn't fixed, it was floating, and it was all up working off the assumption, oh, we're going to be able to refinance in 2 years and it's going to be at this rate. Well, when that rate was double or triple, depending on how you look at it, all of a sudden that deal doesn't pencil. Not only does it not pencil, it doesn't actually allow the final business plan to be complete, and there's even a need for capital calls and other things. So you have to factor in the debt cost, and if it's not fixed today, be thinking about, well, what is the worst case it could be, and underwrite to that. If it still makes sense, then
Yeah.
rock on.
I want to come to you, Wyatt, because as you guys are sitting there working through the due diligence checklist with the investors in the lab, how do you see this as if cheap money returns? What should we be considering?
Uh, you just got to be cautious for sure. You got to look at the operator that you're working with. That is the key part of an investment. Don't just chase a high yield and a pro forma. Really know who you're working with and focus on quality. And that's the one good thing about the passive income lab is that you're in a group of folks and you get the chance to talk about a lot of those operators that are out there, and you hear stories of what went well and what didn't go well. So there's a lot of learning that goes on.
Yeah, the cheap money brings in the amateurs, doesn't it? Like, I mean, I think there's a lot of people out there that are like, man, I figured that out in the, 2023, 2024. A lot of people who are like, man, I've watched everybody else do this. Why can't I? Right? I mean, I've owned a rental house. I've owned a house. Why can't I own a multifamily property? And next thing you know, rates change and they can't exit. And so then they didn't gauge. They didn't put the reserves in place, right? They don't. Maybe they do 5 of the first 7 steps right, but they didn't understand what steps 6 and 7 should be. And when the things change, right, then that black swan event just wipes them out. All right, Joey, what should someone do today as a result of thinking through um, these potential changes as they consider the end of the year and into 2026?
Well, I'll tell you, you got to know your numbers, understand how these things will affect you, whether it's in your policies, in the various portfolio assets that you have. What's your dividend rate on those? What's your loan rate? That spread is what we've been referencing today. If you don't know those, you don't know if you have opportunity or not. And then I would also say, as you look at your different asset classes that you have in your portfolio, assuming that you are investing, then be on the lookout. If you could all of a sudden refinance something that's already cash flowing and get a much lower interest rate, all of a sudden the valuation of that property just became more valuable. So think about it from that angle. And the last thing I would say is we're working a lot today under the assumption that you are an investor. I cannot tell you enough. If you haven't taken a step to join us in the lab, do it today. See if you qualify. Go and apply at choosepassiveincome.com. Work with guys like Wyatt and our other coaches in that lab and go ahead and get this under your belt so that you can take advantage of these opportunities.
Anthony, final thoughts.
Final thoughts. I would say in summary, we're talking a lot about interest rates. The most important thing isn't what the interest rates are, is that you have a system of creating passive income. Interest rates are going to go down, they're going to go up. The important piece is you have your money accessible. And like Joey mentioned, you know your numbers. And let's work on increasing the passive income numbers. Don't get too caught up with the ups and downs of the volatility of the interest rates.
Wyatt, what's your final thoughts as we consider what may or may not happen?
Say that people can forget that lower payments come with higher prices, and you can't refinance overpaying. The smart move to make is to not try to time what the Fed's going to do, but just be ready. Just kind of have your system in place, have your dry powder ready to go, and when you see an opportunity present itself, be ready to jump on it.
Yeah. So Sam, you got to know your numbers. You got to define your buy box, know what a good deal looks like. Build liquidity now, right? We talk about that all the time, as having this infinite banking concept within our passive income operating system provides us the ability. There are no good or bad investments, right? There's no good or bad rates. There's only good or bad investors, right? There's investors who've been making tons of money over the last 2 years when rates have been as high as possible, right? We've had one of our guests on the podcast who has been buying deals at 3 and 4% interest rates, 2% interest rates over the last 2 years when everybody else is paying 8%. How's that possible? Because he's a good investor. He understands how to get access to deals. You know, the amateurs are going to react to what the Fed does. The pros will prepare. Let's be pros. Thank you so much, Wyatt, Anthony, and Joey, for being on the podcast. Thank you for listening. I hope you found value to this. Come back and we'll do it the next time. Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand, so that your wealth will never run dry. See you next episode.